Bloomberg Tech is live from the heart of Silicon Valley with Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Microsoft soars on cloud growth as its AI gets traction. Meta plummets as Zuckerberg's AI bets pitch falls flat on high spending. Plus, Qualcomm also out with earnings and warnings of component shortages and rising costs. We speak with the CEO, Cristiano Amon, and then it's all eyes on Apple. After the closing bell today, as Tim Cook gives his last earnings report as CEO. Let's get straight to our top story, earnings, and we start with Microsoft. The stock's up almost 15%, on track for its biggest jump since October of 2008. Bloomberg's Brady Ford's here. What do we need to know?
The print really gave us everything you would want. Highest cloud growth in years, moderating pace of spending, Copilot seats up. The big theme this year has been all this money the hyperscalers are throwing out. Are they going to see a return? And Microsoft showed us increasing growth and that there is at least an end in sight to this constantly ratcheting up level of spending.
All right, Bloomberg's Brady Ford, thank you very much. Let's keep it going. And more on Microsoft. Gabriela Borges, Goldman Sachs Managing Director, Senior Software Equity Research Analyst, maintains a buy rating on Microsoft, raising its 12-month price target to $640 from $610. Azure growth at that level, it seems to be the main metric. So let's start there. What do we actually learn about that ROI through the Azure number?
Hi, good morning. It's interesting because from the outside in, we can certainly see component pricing moving higher. We can see CapEx announcements. We can see memory pricing. But we don't always have perfect visibility into the other side of that equation, which is Microsoft's ability to monetize the ROI on the other end in the Azure business. And there are a couple of really interesting dynamics this quarter, wherein you take something like GitHub, for example. GitHub has now moved to being able to be monetized on a consumption basis for power users, such that as customers get more value out of it, well, Microsoft directly gets more monetization out of it. And so I think you're seeing more breadcrumbs around Microsoft's ability to pull varying levers on the monetization side that perhaps were not nearly as obvious before.
Gabriela, what I found interesting was to look back at Alphabet and say, what were the non-financial metrics that Google shared about Gemini? And then how did Microsoft kind of do the same? So Copilot, 30 million installed seats at the end of the quarter, up from 20 million at the March quarter. Is that useful information to you for how Microsoft's offering in AI is gaining traction?
One of the bear cases on this stock for the last 6 to 12 months has been that Copilot is just not as good a product as it could be. And at the same time, we've seen so much energy from Microsoft into making Copilot a better product. I think about things like the Work IQ integration from November, where it gives you more context on where you sit in the organization. I think about better semantic search and indexing. And then most recently with the Cowork Edition, you're bringing the best of some of the leading frontier models into the Microsoft ecosystem, where they can also benefit from Microsoft security, reliability, all that good stuff. So we've been waiting to see some of the industry feedback get better on Copilot. Industry feedback is getting better on Copilot, and then to see it in the numbers just sort of reinforces that positive feedback loop on, okay, we're starting to move in the right direction, and there's momentum that's picking up.
We're still zeroed in on capital expenditures, but one of the things I found really interesting about Satya Nadella and Amy Hood's commentary was them talking about the real world. Let's get a sense of that from Nadella himself.
We're also bringing capacity online faster than ever. Over the last fiscal year, we've reduced dock-to-live times for new GPUs in our largest regions by nearly 50%. All up, we added another gigawatt of capacity this quarter and remain on track to roughly double our overall capacity in just 2 years.
If you believe the demand story, they're moving pretty quick to get the compute on the supply side. They also made, let's call it an accounting change, right, which altered the CapEx figure. How did you alter your model in response to that?
The mechanics on the depreciation schedule is pretty straightforward. We have an estimate of what is long-lived assets and short-lived assets, and you can run that through your model. I think the industry dynamic that I would overlay on the top of this is a little bit of a shifting center of gravity, where you're hearing more discussion around being nuanced on the types of algorithms that you're routing to types of models, whether that's open source, open weights, frontier models, Microsoft's own internal AI model. And the interesting thing about this is, yes, on the one hand, you have the CapEx, but then on the other hand, what are you doing from a software platform standpoint to really get maximum value out of monetizing the CapEx? And I think that part is where the industry conversation has really started to change over the last 3 months.
If we put Microsoft, Alphabet, Amazon, and let's throw in a few others in there, side by side, purely on stock performance year to date, Microsoft would not be number one. My question to you is, where does Microsoft stand in the AI race in terms of leadership of product, the platform offering that you've just outlined?
There's two parts to this question. There's where do they stand on an absolute basis, and then there's where does the market think they stand on a relative basis.
Exactly.
And one of the ways we've been talking about Microsoft relative to its competition is this idea of discovery value. And Microsoft has been in this penalty box for a number of quarters now, where you can, in any given quarter, say, look, Google is ahead with Gemini, or Google is ahead with its internal silicon strategy. Well, the beauty of what we think is going to happen with the Microsoft stock over the next 12 months is it's not as bad as people think it is, and it's actually been pretty significant improvement behind the scenes. And so I would focus on this concept of discovery value. I think there's a lot of discovery value to unlock in Microsoft as we learn more about the progress they're making on their AI strategy.
Gabriela, to end, I'd love to have a technology conversation with you. You know, I grew up on Microsoft, learned to use a computer through Windows 365 more recently. And then last week I turned on my smart TV and it was saying you have Copilot installed in here. And I'm just thinking, what? Like, I have no idea how to make use of Copilot on my smart TV. Reflecting whether it's within Goldman or like in your own personal life, like, how do you see the utility of Copilot and Microsoft's AI offering at the individual level?
We're in this period of discovery where, by necessity, you have to throw a lot of spaghetti at the wall in order to find good product market fit, in order to innovate. And one of the questions that we spend time on with all of our companies is, okay, tell us about the pace of innovation. What are some of the really cool things that you're doing in-house? Tell us about your engineering culture. And all of this comes full circle. So as a consumer or as an end user, you'll try a lot of different things. Some of the product market fit isn't going to be quite right, but we'll get to a period where you'll be able to see the types of flavors of Copilot and the types of use cases maturing, and you'll be able to get good utility out of that. And I have no doubt we'll be in a position 6 months from now, a year from now, and even as I reflect back on our own experience at Goldman Sachs over the last 12 months, the progress that we've made with being able to see how these tools can actually help in our day-to-day, there's been a lot of progress. There'll be a lot more progress. And I think we still are figuring out where this technology can really take us from a productivity standpoint.
Again, this is a big earnings move in the stock, up 14%, on track for its best day since March of 2020. But at one point in the session, on track for its biggest jump since October of 2008, which says quite a lot. Gabriela Borges of Goldman Sachs, back on the show. Thank you very much. Meta is a very different story. Meta is down 8%, on track for its biggest drop since October. Meta's disappointing forecast, increasing pressure on CEO Mark Zuckerberg to prove that the AI bet is and will be fruitful. Let's listen to him.
Our investments in AI are accelerating every major part of our core business. They're improving the experience for people using our apps, driving better performance for advertisers, and helping our teams build new experiences and ship faster. Second, we are developing new personal agents that will be the foundation for our next wave of products and revenue lines in the months and years ahead.
Bloomberg's Riley Griffin leads our coverage of Meta and joins us now. What do we need to know? There was so much in this earnings print and earnings call.
I think the two most important numbers from yesterday are 28% and 55%. 28% is an increase in revenue year over year. Sounds like a lot, brings us to $60 billion for the quarter. But expenses, 55% increase there. There were a couple of one-time charges. But here's the thing. The funding coming from the core business to fuel this AI race is just not going to be enough. And investors really want to know, when are we going to see that return on its investment, and what revenue lines are actually the future? We've talked about cloud business here. He didn't provide a lot of clarity there. We didn't get names, deals, financing, timelines, and the market really wants that.
Bloomberg's Riley Griffin, thank you very much. And we'll stay with Meta. Joining us is Shweta Khajuria, Wolfe Research Managing Director of global internet. And I'm going to pick up on what Riley was talking about. Mark Zuckerberg, and I'm paraphrasing, essentially said, sure, we could just rent out GPUs, but the best value on the infrastructure is to build a layer on top of it. And to me, that sounded a little bit like AWS Bedrock. It sounded a little bit like APIs for enterprise, but we just didn't get that crystallized. What was your interpretation?
First of all, thanks, Ed, for having me. On that particular comment, my interpretation was that, well, the value is certainly in intelligence, and that's where people are focused on. But then over time, as they make the model available, what is built on top of that model is going to be incredibly important. And so they'll have to flex their muscle because they don't have competency in the larger enterprise side of it, which he was very upfront about. And quite candidly, investors are skeptical about. And then the other side of it was also with that, they have a huge SMB base against which they can, who they can leverage with this model. So that was my interpretation, that they want to make this model available, they want to be vertically integrated, and they want to offer value to larger enterprises against which they need to build that muscle, as well as SMBs over time.
They kept the capex ceiling at $145 billion for the year, but raised the low end of the range to 130. Nothing for next year. How much is that a factor in this market?
For this year, not as much. I think it was just a narrowing of the guidance because they have greater visibility. The next year's number is now, people are anywhere from $230 to $260 billion, which is a very large number against their operating cash flow, which is going to be arguably closer to $200 billion. So the concern here is that there is likely going to be a need for a capital raise, perhaps a $50 to $100 billion of capital raise, or more JV partnerships, both of which are a cloud over the stock.
A cloud over the stock. And there's been discussion about going to the equity markets. Free cash flow, lowest level since 2022. Does that worry you?
Absolutely. The benefit that Meta has is that, and other hyperscalers like Amazon and Google, is that they have very large operating cash flow. So the fundamentals of the business in general, because it is an advertising business, higher margin, they can generate almost $200 billion in operating cash flow. So without any capital raise needed, at least they can spend that amount of money, flatten out free cash flow for a little while because there's demand constrained environment, and then sort of show the upswing in free cash flow when everything normalizes. That's what they're playing for. But I guess investors are losing patience because they don't have much to show for it, especially against decelerating advertising revenue as we now look at the back half of this year.
We're back to talking about Meta through the financial metrics lens. Did you learn anything, Shweta, about how AI is making improvements on the ad side, about Meta AI through smart glasses, anything that shows Meta's plan for AI is getting traction in the world?
Well, the place where they get credit in their advertising business is that their advertising business is still growing at a fairly good clip. For a business this size that's going to be as big and or surpass search revenue at Google is very remarkable. And they're growing in the mid to high 20% range. So that in itself is very strong growth rate, just that may not be enough against the amount of spend they are doing. So why is that when the overall digital market is growing at, call it 11 to 12%, and they're growing more than double that clip? And it's because of the AI integrations that they're doing that is making the recommendations and targeting a lot better. So they do get credit. It's just that they're spending a lot more than what they can afford to spend right now.
Bloomberg's Riley Griffin explained expenses 55%, operating margins contracted year on year. And what Meta would say is, were it not for that $3.6 billion in two different one-time charges, then you would have seen operating income rise. Yeah. What if? Do you buy that?
I do. I do. Those were one-time-ish. The modest pushback that I have is that they are not in the clearing with the regulatory risk that they face from U.S. states attorney generals and or EU. And so I'm not sure how one-time-ish that really is if the risk is ongoing. My hope for them is that they can bring it to a settlement. they make a large actual one-time payment, and then they're through the clearing. So to the degree that it really is a one-off, yes, it does make sense because their operating business, their real operating income is still growing, and they expect that to grow on a full year basis. The challenge is the depreciation spend is $30 to $40 billion, which is rising fairly rapidly, and that's something that they'll have to address.
Wolfe Research Managing Director of Global Internet, Shweta Khajuria, thank you. Now, coming up, we're sticking with earnings and we're looking at ARM, and this is what ARM shares look like, up 6%, off the back of strong data center royalties and CPU demand. This is Bloomberg Tech. Samsung posted a 250-fold surge in chip profits in the June quarter as the memory crunch showed no signs of easing. In fact, rising memory prices are creating a challenging environment for Samsung's own mobile device operations. South Korea's largest company says it expects the memory shortages to worsen next year. The comments echo those made by rival SK Hynix as AI growth fuels demand. Sticking with chips, shares of ARM, this is what they look like. The company reporting slowing smartphone royalties offset in part by data center and CPU demand. The stock strong, up 6% off session highs. Let's discuss with Timm Schluze-Melander, head of technology hardware and semiconductor research at Rothschild & Co. Redburn. I find ARM so interesting because they will tell you, well, if units are doing this, royalties are doing this. They have a very different business to the fabulous chip makers that we're going to talk about later in the program. Let's start with your sort of main reaction to the print.
Yeah, thanks for having me, Ed. So at the end of the day, optically, an inline print, nothing really to get too excited about, and also a guidance that, frankly, is pretty pedestrian. I think as we look at the earnings season to date, even companies that have delivered stellar earnings and really remarkable EPS revisions for consensus estimates have really struggled to make positive share price moves in the following days and weeks. And so this was, frankly, pretty pedestrian. I think when we opened up the hood and just looked into the detail, the things that really struck us were some of the themes that have kind of been a challenge for the investment thesis over the last couple of years. The first one, as you point out, is royalty growth. This is still a company that is still over-indexed to mobile handsets. You referenced Samsung there, the memory cost inflation harming their handset sales. That's really going to be a topic in the back half of this year for ARM. It's already harming their royalty revenues. It's worse than they expected. They thought it was going to stay at the bottom end of the market. That's actually starting to drift up, affecting mid and high-end phones. That's going to be a topic tonight with Apple as well. And so there's some licensing revenue offset that help kind of patch the quarter and is holding the fiscal 27 estimates, I think, for consensus broadly unchanged. Right. But there wasn't really anything to get excited about in the print, whether it's royalties or the AGI CPU outlook.
Well, quite, Tim. The thing that Rene Hassanan want us to get excited about is the push into data center. CPU is a story common to many at the moment. There's momentum there. Did ARM show real penetration, real momentum in the segment?
So the one-word answer is probably yes. The challenge for investors is that it's hidden. It's hidden inside their royalty revenue disclosures, which are generally pretty opaque. And the data center part of that business is actually still, even though it's doubling year on year, still relatively small. And so it struggles to move the needle. And that's really the problem in a data center and an AI world where, we're talking about hundreds of billions of dollars of spend. If you're ARM and you're earning 50 cents or $1 per core, and maybe you're earning somewhere in the region of 80 to $100 a chip, it's really hard to generate meaningful revenue that's really going to move the dial.
Tim, tee us up for Apple tonight. The big watch for you beyond Tim Cook's farewell call.
Right. Look, it's going to be super interesting. One of the peculiarities of the last quarter has been that price rises and cost inflation and others has actually helped Apple's relative performance. So they've actually had a really good June quarter. All eyes on what they do into the September quarter. the step into foldables, how do they refresh the Apple Intelligence? As you say, Tim Cook's kind of farewell quarter and the maiden quarter guidance, which John Turnus is going to be reporting on in October. I think for us, the momentum in the business is good relative to the peer group, but that doesn't change the fact that rising input cost inflation makes for a pretty tricky trading environment for everyone.
As a clear reminder, Tim Cook's not going far. He becomes executive chair September 1st. But it is his final earnings as CEO. Tim Schluze-Melander, head of technology, hardware and semiconductor research at Rothschild & Co. Redburn. Thank you. We're going to keep the conversation on chips going with the CEO of Qualcomm, Cristiano Amon. That's later in the hour. And coming up, SpaceX's Starship ambitions may face a major roadblock, according to former NASA researchers and experts. We'll get that story next. This is Bloomberg Tech.
It's time now for Talking Tech. I'm Yahaira Anand. First up, Blue Owl's data center firm Stack Infrastructure is seeking a $5.9 billion syndicated loan to fund its latest project in Melbourne. That's according to sources. This could be one of the largest such financings in the sector in Australia. Plus, 3 former NASA researchers and experts say the heat shield that protects SpaceX's Starship vehicle may be a major roadblock to designing a rapidly reusable rocket. The protective tiles suffered a significant damage during a recent test flight, which could lead to lengthy downtime between flights and curb Elon Musk's ambitions for rapid reusability. And Disney's new CEO, Josh D'Amaro, has instructed his leadership team to think of Disney Plus as the front door for the company's worldwide fans, as it plans to add new features to better compete with Netflix and YouTube. It's also bringing Hulu and ESPN content onto the platform while investing in local programming in international markets. Ed?
Thank you, Yahaira. Now, coming up, K2 Space CEO Karan Kunjur joins us to talk about the satellite startup's latest funding round and a big valuation, $6.8 billion. We'll head to private markets, we'll head to space. This is what public markets look like in the tech space. NASDAQ 100 is higher, 2.6%. The Sachs is up almost 8%, but remember, it's come off 5 straight days of losses, totaling a 16% drop. So some of that is earnings, sure, with ARM, but a lot of it is undoing the decline over an extended period that we've seen. There's so much more to come, right? There is the earnings story that's gone. Microsoft is up 14%. Right now, pretty much the best gain since 2020. At one point, biggest jump since 2008. But Meta is down significantly, the most since October. Apple and Amazon are up next. 2 very different AI stories, but AI all the same. Beautiful pictures from the Bay Area, San Francisco. Halftime, this is Bloomberg Tech. Welcome back to Bloomberg Tech. The AI buyers are back, and you look at the NASDAQ 100 up about 3%, 2.5% in the session. The Philadelphia Semiconductor Index, or SOX, which is the chip index, is up a lot, 7.4%. But remember, it had been down for the last 5 days prior to today, a drop of like 16%. So maybe there's a bit of evening out. Microsoft and its earnings are a big factor in this market. Right now, Microsoft's up like 14%. Had been higher still than that and on track for its biggest jump since 2008. All of that is earnings digest, and there are more earnings to come. Let's talk about it. Bloomberg Equities reporter Ryan Vlastelica joins us now. I mean, you and I were chatting this morning. There's a lot going on in this morning's market. Earnings are a factor, but the recent downward pressure on technology stocks, clearly that's at play too.
Yeah, exactly. I would say that's very much the case right now. I have a couple people describing this really as sort of a elastic band market where it's really stretched in one direction, and when you get a snapback, it can be extremely volatile going back on the other side. That said, there were a lot of positives, especially in Microsoft's results last night. Very strong cloud growth, very strong adoption of Copilot, and it had some positive comments on CapEx, which really, I think, threaded the needle because they continue to spend, which is positive for the chip space, but it really felt like they did a good job of helping to justify all the spending they're doing. They talked about how a lot of its data center buildings would be useful for 10 years or so. So eventually we are going to see this maybe taper off a little bit, but I think today at least it's positive for the chip space, and it was also positive for Microsoft justifying its own strategy.
AI-linked stocks rallying on big tech results and CapEx plans. And then there's tonight, where Amazon will talk about all of those themes. Apple's there as well. I know you've been thinking about Apple. How does that fit into the market this week? What we're going to get after the bell?
Very curious to see what Amazon has to say about CapEx and how the market receives that. Amazon is another company where I'd say there's a lot of optimism that all of this spending is going to pay off, especially as they talk about using AI in its warehouses and for logistics and things like that. That's a very clear way of seeing how all of the spending can translate to improved efficiency, improved profits. And because you have AWS, which remains the leader in cloud, I think people are expecting a pretty good read there. So that could be another sort of read more in the vein of Microsoft as opposed to Meta, which had a disappointing revenue forecast, making it harder to sort of justify all this spending.
Right.
It's also continuing to spend a lot. That's why you're seeing that stock really pull back today.
I borrowed a line from your Apple report this morning on Bloomberg Surveillance, and one of the analysts reacted to it straight away saying, can't believe we're calling Apple the AI safety play or the safety trade. But it's kind of like how the market's treated it.
Yeah, exactly. I think if you look at a lot of the major themes that have been in the market this year, at least as it pertains to tech, Apple is really separate from all of them. So if you are concerned about the level of AI spending, Apple's not doing that AI spending. If you're concerned about AI disrupting software, it's not disrupting. Apple doesn't really fall into that category either. Now, there are some concerns that people have about Apple, notably the impact of higher memory prices. But I think Apple is so dominant in the hardware space that it's probably better able to weather some of this than some of the peers in the hardware space that are maybe geared towards lower income consumers. And then we have the foldable iPhone later on this year, which is expected to be, coming at a high price point that might allow Apple to sort of pass on the impact of higher component costs to the consumer without it being sort of the sticker shock that you might see elsewhere.
That's what's happening in technology stocks. Bloomberg's Ryan Vlastelica, thank you very much. Let's switch over to private markets, where interest in backing space firms, particularly following the SpaceX IPO, remains very high. The latest example, K2 Space, just closed a $500 million Series D round. The firm builds large satellites for data-heavy communications, defense missions, etc. The valuation also very big, almost $7 billion. CEO Karan Kunjur joins us for more. Let's start with what is a big backing of your company, a big round. Iconic is in there, Kleiner Perkins, Lightspeed, Capital G, Altimeter. The list is long, but those are our top-tier investors. What is it that they think they see in K2?
Yeah, space is becoming an infrastructure play, right? And you're seeing applications like communications and compute going from the ground and the air to space. And so we started K2 to go build the highest power, most capable satellites that have ever been launched. And I think these investors saw that what we had built was something super different, really differentiated, massive moats from a technical perspective, and a really solid book of revenue to build off of. And so, yeah, we're really excited to announce this round. It's a big round for us, and we're excited to bring a bunch of those names onto our cap table.
So K2 can do quite a lot with $500 million because the whole point of the design you have is that you can produce very fast at low cost. Low cost being $15 million per satellite. Is that kind of the play here to get funding to move quick?
Exactly. Yeah, the capability that we're delivering historically was done by a $1 billion satellite made by one of the primes. It cost, $1 billion and took 7 to 10 years to produce. Like, our whole play was, how do we figure out how to take on all of these hard engineering challenges, giant solar arrays, giant batteries, giant reaction wheels, figure out how to do that in an industrial way, turn it from something that used to be a science project to something that's mass producible. And if we could do that, we could reset how we roll out infrastructure layers in space.
If you're the domain expert in very big satellites with high power requirement, does SpaceX or someone else give you a call, Karan, and say, look at our design for orbital data center, help us?
I think people saw the 20 kilowatt satellite that's now flying on orbit today, and they're starting to hear about our plans for what we call the 100 kilowatt class satellite. It's actually a bit more than 100 kilowatts, but we'll save that for another day. But it's one of the largest, highest power satellites that has ever existed, and it's what makes orbital data centers possible. So while it's not SpaceX, almost everybody else has been reaching out to us asking to work with us on that capability because, going high power allows you to put up a lot of compute. Being able to put a lot of compute on orbit fundamentally changes the economics, the scalability of compute, especially at a time where we're, pretty constrained from a supply perspective on compute. And so we're excited to be in the middle of that. We're going to be working with a number of different players as we roll out that differentiated capability.
It's been nearly 4 months since you deployed your first satellite. What has the learnings been in that time?
Yeah, I think at this point, we're like 120 days in, and it's been amazing. Like, we've learned a ton. The entire tech stack was all brand new, right? About 85% of the satellite was built in-house. We had to design it because these subsystems didn't exist with this capability. And so this was a major de-risking moment for the company. We've collected a tremendous amount of data on the performance of the platform across different thermal situations, across different power situations with a bunch of different payloads. All of that has now been fed back into what we call our Block 2 design, which is going to be rolling out next year and launching across 2 different launches next year as we scale the company.
You have some contractual obligations to the government around Golden Dome, for example. What's the pressure of that to meet deadlines, to be able to pull it off?
Yeah, at this point, we've sold about $1 billion in contracts, right? We crossed the $1 billion mark a few months ago, and a lot of it was on the back of this successful first mission. We have a number of national security customers that are incredibly excited about this capability and what it could do for future infrastructure and architecture plays that they're thinking about, right? And so, hitting schedule is incredibly important. We did that with this first mission. We've now got a tremendous amount of demand. A lot of what we're using the fundraising for is to go make sure that we can de-risk the supply chain, de-risk the subsystems, mass production, increase the footprint, and make sure that we're continuing to execute to satisfy the massive demand that we're seeing.
Karan, real quick, your launch provider, and what does launch capacity look like for you guys going forward?
Yeah, so the first satellite, the 20 kilowatt satellite, is made for any 5-meter fairing class launch vehicle. To date, we've launched on Falcon 9, and we'll continue to launch on a number of other launches with SpaceX in the future. Beyond that, we'll use other players that are building 5-meter fairing class launch vehicles. And in the future, the 100 kilowatt class satellite is designed for much larger, super heavy launch vehicles like New Glenn and Starship. So we're pretty excited about the new launch vehicles that are coming online. We're excited about what SpaceX is doing. And we just want to be able to take advantage of the launch options that are going to be out there over the next 10 years.
K2 Space CEO Karan Khajuria on Bloomberg Tech. Thank you very much. Now, coming up, Qualcomm warned of component shortages and rising costs in its quarterly earnings report. We're going to discuss all of that and actually a lot more with Qualcomm CEO Cristiano Amon. That's next. This is Bloomberg Tech. Back to earnings. Qualcomm giving a weak profit forecast for the current quarter, citing component shortages, rising costs. That's a focus on the smartphone market. Shares down almost 3%. Qualcomm President and CEO Cristiano Amon joins us now. The way that I think about Qualcomm, Cristiano, is that it's one of the most interesting transition stories in semiconductors, probably since NVIDIA, right? The business right now, smartphone, is under pressure. The market is focused on that. Let's get it out the way. How long does that pressure rise? What is the mainstay of the pressure? Is it in production? Is it on the pricing side? Tell me what you see.
Yes. So look, let's step back a little bit. What's happening with the handset market, and there's a handset market and there's a unique Qualcomm thing. Happening in the handset market is there are unprecedented memory prices and shortage. I think the price increases are very dramatic, as everybody know. I think you're seeing not only Qualcomm talking, you see some other companies talking about it, you see Apple talking about it. Therefore, I think what happened in the market is down. We actually project, and just when we think about from 26 to 27, the market's going to be down by about 20%. This is not because of demand for phones. This is because of there is not enough memory. The prices are so high, so the units are much lower. Consumers are kind of react to the lower price. The middle and the low part of the market, it's significantly contracted. The premium tier has some resilience. But even in the premium tier, what we see is a mix change. Consumers are preferring with the new prices that are higher to buy last year phone. They buy the entry premium. And I think that's actually causing this change in the market. There's a unique thing about Qualcomm, which is well understood, which is Apple's coming off the model, and is actually coming out faster because of the supply situation. So that is the situation in the short term. That is what's causing this issue. And it came out in the earnings reflected in two things. I think a weakness on on handsets. We actually did the following disclosure. We talk about it. There's about $1.50 in earnings power that it's now will come back to Qualcomm when handsets normalize. And it is the overall market is down. It's not a demand issue. It's memory prices and supply. So that's the handset story. And that it reflected in earnings in two pieces, right? You saw, I think, the weakness on the guide, which is a market weakness, a mixed change. And then there's gross margin. The gross margin is very simple. We're slightly below the operating model of the company because input costs are up. In a shortage, and we've seen this during the pandemic, the entire semiconductor industry right now is at full capacity. So costs go up. We're adjusting pricing. But you have contracts, you have new design cycles. So there's a mismatch in quarters between the price adjustment and the cost. That creates this temporary, I think, issue on the slightly decline on the gross margin, and we're going to go back as prices flow through the model in the handsets. We're going to go back to the operating model. The exciting thing about the company is the new business and how we're actually transforming the company,
well,
as you pointed out.
Let's talk about it. In the past, we've called it diversifying. I called it transition, but I read the earnings presentation slides. So you're saying in full year 27, non-handset is just under 50%. And by full year 29, that handset business, which is the majority today, is only 1/3 of data center, automotive, and IoT. What pushes that most?
Yes. So this is a great question. So if you actually look what is happening with the company, everybody knows about this Apple transition on a handset, and then all of the growth that we've been doing with everything we did to transform the company. A couple of things that are actually driving this change. We actually talk about from this year, fiscal 26 to next year, growth is going to be 60% on no handset. And the driver is automotive. We actually, in the earnings call, said we're exit rate now, we're about $1 billion higher for 27 than we actually thought. It's continued to accelerate because of our position. Automotive is getting stronger. We have now more assisted driving and autonomy silicon and evolving over stack. The second thing is this beginning of the data center ramp. We still restated $5 billion in data center revenue in fiscal 27. And the IoT is starting to grow. On industrial, there's a lot of this conversation about open weight models, about AI on the edge. On industrial, in this fiscal year alone, we have about $3.5 billion of design win pipelines. So all of those things are going to go to, the projection that we made of $40 billion of non-handsets by fiscal 29. And you're going to see a 60% year-over-year increase on all of those new business, durable revenue, durable earnings, doesn't have the cyclical things on handsets. And I think that's really the future story of Qualcomm.
This is Bloomberg Tech, live on Bloomberg Television and Bloomberg Radio, and we're speaking to Qualcomm President and CEO Cristiano Amon. It wasn't that long ago we were talking at Investor Day where you laid out a $15 billion plus a data center opportunity through to 29. How's that going? I know it's been just a few weeks or months, but what progress have you made?
Yes, it's going very well. The most important milestone for us right now, I think, look, we outlined that we built a roadmap that has products coming over a couple of years, right? We've been very clear how the roadmap is evolving. So the first set of revenues, which actually is the majority of the $5 billion that is happening right next year, it's a custom ASIC with two hyperscalers. Everybody asks us about who they are. The only thing I can say at this point is one in the United States, one in China. But the most important thing is when you think about the composition, the $15 billion, it has custom ASIC, but it has our accelerator, has our new high bandwidth compute, which is a new memory architecture, and it has our CPU. So the exciting thing is we're going to have in a couple quarters, we have, progressing with the development. In a couple quarters, we'll have silicon on the HPC that we're going to make people will be able to evaluate, I think, the performance claims. And I expect that is actually going to create even more interest than what we have today within the $15 billion.
Cristiano, the way that I look at Qualcomm as well, like on the smartphone side, Android in China. And then when I'm thinking about the data center, I'm trying to understand where the biggest opportunity is. So geographically, China or US, and then there's ASICs or your own products. Try and put them in order for me of priority.
Yes. When we provided the 15 billion number for fiscal 29, it's kind of well balanced across, custom ASIC with hyperscalers. It's especially for new entrants, you should expect a lot of bespoke development. It's very well balanced on the CPU, which will start ramping in 2028, and the accelerator in HPC. But also, when we talk about HPC and the accelerator, HPC is actually part of some of custom ASICs deployments as well. As far as China, you should expect that our exposure to China to data center will be very similar as a percentage of data center revenue to all of the other semiconductor providers there are in the data center business today. China it's a big market. It's just a function of GDP, and when you look at some of the data centers, especially the providers of custom ASIC, they have exposure to China. Ours is going to be about the same percentage.
Understood. Software. You closed the acquisition of Modular. You have some ownership in the software stack. People don't talk about that as much, maybe, but where does that fit in your strategy, Cristiano?
Yes, I am super happy about this, and one of the reasons I'm very happy about this is not everybody understands it, so I'll be able to brag about it a few years in the future. But the exciting thing about this is a great team. I think they have an incredible track record. The founder and CEO and his co-founder have a track record about what they have done in the Apple Swift programming language, the inventor LLVM, I think the developing the Tesla Autopilot, and they put on a mission to create a open platform for AI that scale from edge to cloud. It's a modern stack development, and we're very excited about what we'll do for Qualcomm and actually for the whole industry. I think we're really committed to provide that open platform for the whole industry. The interest has been incredible, including from other semiconductor companies, and we're just going to be executing. The good thing about all this, Ed, nobody asks me anymore about, I'm worried about your software capabilities in the data center. I think this is an incredible acquisition.
Just super quick, the second half of this year, very quick, smartphone deteriorates, or you see signs that it improves over what timeline?
Yes, the important thing, what we stated before, the Q3 quarter is the bottom for China Android. That's still the case. We will see sequential growth on Android in China. We will see it. Having said that, the market is down. I think it's not a demand issue. Consumers actually want, there's demand to buy phones. It's just this memory prices and supply. So you should expect the market to continue to be suppressed, even though I think we called the bottom on Q3, and that is still the case.
Qualcomm President and CEO Cristiano Amon, back on Bloomberg Tech. Thank you very much indeed. Apple reports after the bell, and it's the end of an era. This will be Tim Cook's final earnings call as CEO, with investors watching iPhone sales, AI, and what's coming next under incoming CEO John Ternus. Bloomberg's consumer tech and Apple managing editor Mark Gurman is with us now. Where would you like to start? I think let's start with the Tim Cook of it all. And it is a big moment in the history of this company and in the transition to its future.
Yeah, this third quarter, this is Tim Cook's final full quarter in charge as CEO of Apple. He will remain CEO till September 1st, which means he'll be in charge until 2/3 of the way through the fourth quarter. And that is all to say that this will be his final earnings call. So you'll probably hear John Ternus on the call today. You'll hear them talk about the transition. Tim Cook is going to want to reassure Wall Street that things are going to remain steady under Ternus, tell them the transition has gone unbelievably better than expected. Any way to describe this in a positive way, they'll use today as a forum for that. The product pipeline is extremely strong, and we'll see Ternus announce the foldable iPhone, new Apple Watches, and a few other big things in September. Tim Cook here is handing Ternus a layup, I believe. We're floating around a $5 trillion valuation here. The numbers today are probably going to beat Wall Street expectations. They're looking for about $109 billion. I'd be surprised if it came in below that. So today's word is going to be transition, and the other one is probably going to be continuity.
The environment is tough, right? Principally, we talk about memory. Where will that show up, Mark? This is a company that handles the bottom line well.
Well, they raised prices at the exact time they needed to raise prices in order to offset things. So even if the memory shortage is going to continue to create headwinds for them, the price increases are going to erase that when it comes to their margin. And given the demand for the new products in the fall, the price increases may even lead to higher revenues. So margins likely stay steady, revenues likely to go up. They're going to have their cake and eat it too.
What's the one product that's going to be most important in the John Ternus era?
The one product that's going to be most important in the John Ternus era is going to be the iPhone. And I say that because I strongly believe the iPhone is going to remain the center of the Apple universe. And Ternus will need to evolve the iPhone under new form factors, under AI, over the next 15 years. Because I believe people will always carry something in their pocket. You probably thought I would say glasses is the most important.
Yeah.
But I do believe that is going to remain secondary to the phone. Maybe it's 1A, 1B. But definitely the phone is the cash cow. This is where they make $200 billion a year. They're going to need to continue doing that.
Of the $109 billion of revenue, the iPhone will be about $54 billion. Bloomberg's Mark Gurman, busy day for you. Thank you very much. That does it for this edition of Bloomberg Tech. More tech earnings are coming, and this is what the calendar looks like. Apple, Amazon, Rivian after the bell. Interesting conversations to come. Recap the conversations of today's show on the podcast. You know where to find it, on the terminal, as well as online on Apple, Spotify, and iHeart. Just one more day in a big week for tech. Have a great day. This is Bloomberg Tech.